Thanks everyone for joining us for our next Ripple Ventures Tank Talk with Reid Christian from CRV to discuss how a 50-year-old venture fund is investing in SaaS for the next 50 years. Welcome, Reid.
Thank you, Matt. Thanks for having me on.
Now, just a quick background on Reid. He is a general partner at CRV, Charles River Ventures, where he's been for the last 3 years. Charles River Ventures is an early stage venture capital firm that has backed over 500 startups in its 50-year history, including Airtable, DoorDash, Drift, Dropbox, HubSpot, Postman, Twitter, and Zendesk, and the firm focuses on enterprise, consumer, and bioengineering. Prior to that, Reid was at Battery Ventures as a venture investor for 2 years, and prior to that, he was a Symmetric Capital growth equity associate. On the personal side, Reid graduated from Bates College with a BA in economics and was a captain of the Bates basketball team. Let's kick things off and talk about your investor journey, Reid. Can you tell us about your journey in starting on the public markets and private equity side of investing and the lessons you learned about financing and investing in businesses?
Yeah, happy to. I grew up in the great state of Maine and went to a small liberal arts school for undergrad, and then stumbled my way down to Boston and fell into the investment banking world through a couple of alumni, both initially at a small boutique investment bank called TM Capital, focused on IT services and consumer retail businesses, and then RBC Capital Markets, where I was at within the FIG group, focused in particular on specialty finance. And it was kind of through that I got welcomed into the finance world, and then kind of took that, went over to Symmetric Capital, which was a growth equity firm, which I thought was another finance job, but it turned out it was much more of a sales job. And so I was scrounging North America, looking for bootstrapped businesses that were growing and profitable within kind of business services, software, and healthcare services broadly.
Well, I'm sure the sales part being at Symmetric really helped when you made your transition to venture. Let's talk about that transition to venture capital, where you joined Battery Ventures as a venture investor for over 2 years. What was the biggest adjustment for you moving from the corporate private equity world to venture investing?
Well, I did take one brief hiatus while entering Battery and spent 6 to 9 months at a startup in Boston called Salsify, where the first day I walked over to the engineering team and asked them actually what they were doing all day. And one engineer in the back basically was just like, listen, Reid, all we do is build APIs. And I said, what the hell is an API? So to say that I didn't know a thing about tech is an understatement. But landed at Battery, ended up on the kind of early stage venture side, taking my experience of sales, which in the venture world is called sourcing, and realized I knew how to do the job, which was find, identify, and track down exciting entrepreneurs. I knew how to evaluate those businesses and markets. And then I just needed to spend a bit more time on the side, kind of learning about tech trends, architecture, and enterprise software broadly, and spent a couple of years kind of really digging in, doing a bunch of customer diligence calls, networking, and a lot of Medium post reading to get up to speed.
So you learned about APIs, luckily, because while you were at Battery, one of the investments that you worked on was the Series A lead into OpsGenie in 2016 for $10 million. And the company went on to be acquired by Atlassian 2 years later in 2018 for $295 million. Can you tell us about your original thesis behind this investment and the lessons you learned after watching them be acquired 2 years later?
Yeah, it was very simple. I went to Amazon reInvent, which is their annual AWS's Amazon Web Services annual conference, and walked around the floor of all these vendors that were capitalizing on at the time of AWS's phenomenal growth. And on one side of the hall, you basically had all these monitoring companies that would help you understand if your application or your server or your website was up and running. And then on the other side, you had a couple of these companies like OpsGenie that would aggregate all those alerts and go and wake someone up who was sleeping and needed to get up and fix the issue that the alerts had been triggered by. And at first, it seemed like it was going to be the space of kind of on-call alerting, and businesses like OpsGenie felt like they should be a part of the monitoring vendors, so an AppDynamics or a Datadog or a Sumo Logic. But in reality, this was kind of this needed to be a standalone category. It felt like of integrations that integrated across all your different monitoring vendors. And OpsGenie had the best integrations in the market at the time. So spent a lot of time with the entrepreneur, Berkay, traveled to his home office in Ankara, Turkey, and eventually, made the investment. And one of these kind of interesting cases where it was not a capital-intensive business. Berkay grew the company quite efficiently. I believe didn't touch any of the money that we invested, and then two and a half years later was acquired by Atlassian.
Well, I assume that wasn't the plan to have to get acquired so quickly, but it is nice, I assume, when it happens. How did that come to be, and sort of what was your involvement in the acquisition process and helping the entrepreneur, get guided through that?
Well, as always, it's all the credit should and does land on the entrepreneur, navigating, first of all, building the company, timing the market, building the team, selling the customers, and convincing a buyer. I did play a small part in that I initially made the introduction to Atlassian before we even invested, though. I was running around trying to understand who would be good partners, whether this should be part of the monitoring players, or if it should be part of the ticketing systems, meaning Zendesk, Atlassian, ServiceNow. And I went and chatted with all those groups. And it was through that conversation that I ended up having just a phenomenal conversation with the Atlassian team, first of all on the BD and Corp Dev side, then on the product team. And we connected them over as a good partner. Of course, OpsGenie and the team there took that partnership and, expanded it over the couple of years, and they did all the hard work. And Berkay built the relationships with the founders of Atlassian, and that's where the acquisition actually came through. But I do like to take a bit of claim for at least having a small part in the initial introduction.
Well, I think that's an important lesson too for a lot of, emerging funds out there, is that one, doing the work even before you invest to decide if this is going to be somewhere that this company is going to end up is, part of your job. But the other thing is making sure those relationships get stuck together and following up and making sure they kind of, push forward from the entrepreneur's perspective. They have to do all the work, but you were there, thought about the potential connection, didn't obviously think it was going to turn into an acquisition, but there was a part that you played in it. So it's great to hear that there was some connection between you and Atlassian and the company at the end of the day. So as you moved over to CRV, which recently raised a $600 million fund without any face-to-face meetings, despite a pandemic, where you've been a general partner for the last few years. And CRV has been a leading investor in high growth technology companies for half a century. As I mentioned prior, they've backed over 400 startups in its 50-year history, including companies like Twitter, Zendesk, Amgen, HubSpot, Yammer, and Sonos Networks. And half of the companies CRV has backed have gone public or been acquired. What excited you most about joining a fund as a partner?
I think what's happened in the venture market overall is that what used to be kind of a craft business of early stage investing, roll up your sleeves, you have a bunch of great brand name firms that were really focused on this trade of, call it seed, Series A, Series B investing, investing a few $1 million, typically as the first or second institutional investor, taking a board seat, and really signing up for a 10-year plus journey, oftentimes with these businesses through ups and downs. The market has changed so much. You have, it's become kind of a whole asset class of multi-stage investing, each firm raising several funds to cover everything from scout programs through seed to Series A up through growth rounds, and even some firms adding on public market investing. And I came from one of those larger firms that now has a multi-billion-dollar fund and kind of covers the spectrum. And what excites me most as I've kind of navigated my career is chasing down just phenomenal entrepreneurs, really working with them one-on-one, the highs and lows, and partnering up and kind of having that early stage mindset of dreaming the dream, while also, kind of navigating the twists and turns and the kind of hands-on trade craft of early stage startups. And CRV, I believe, is one of the best and one of the few remaining firms that still focuses squarely on the early stage and squarely on enterprise investing, which is what I have come to really love and appreciate. So that's kind of, the cultural side, the early stage focus and the B2B nature of the enterprise team here at CRV is really what kind of drove me here and what continues to excite me about being part of the platform.
That's great. I mean, it sounds like they've stayed true to their focus at the early stage. A lot of funds can get distracted. As you mentioned, they can go up and down the stack and try to be all over the place with billions of assets under management. But CRV has definitely stayed true to what it focuses on most, which is the early stage. And so I'd love to, dig into, how a fund like CRV, 50 years old, is investing in SaaS for the next 50 years. So, what are you looking at? What are you excited about in enterprise SaaS for the next several years?
Yeah, I mean, the main theme that we have been investing behind and executing on is very simple. It's the move to the public cloud. And we've seen that from the infrastructure side, but then we've also seen it with newer applications being architected, obviously as SaaS companies that are easy to adopt, easy to onboard, more bottoms-up adoption. On the infrastructure side, we've kind of made a cutoff point of storage, networking, compute. That's largely going to be handled by the public cloud providers, but the management layer of monitoring, alerting, securing applications is a fantastic area that we'll continue to invest in, and broadly developer tools. I believe we have probably the strongest early stage open source developer tool portfolio out there, focused exclusively on kind of seed Series A, and we'll continue to double down. Anything related with APIs, front-end development, this emerging category within the JavaScript developer community, and then also, again, the management layer of monitoring and securing those applications. We'll continue to spend a lot of time. At the application layer, the opportunity is in a lot of these advances at the underlying infrastructure will give rise to capabilities to build applications in various verticals that weren't necessarily digitized previously, or if they were, not with the nice user-friendly, easy to adopt, easy to get up and running applications. So I'd say generally just very excited about the timing to be a SaaS investor, to be an enterprise investor. And I think we're going to continue to see kind of great tailwinds and trends for 5, 10, 50 years going forward.
Yeah, I completely agree. And we have the same sort of focus at Ripple. People said enterprise SaaS was kind of dying off, in the last few years, but I feel like since, the onset of COVID, that it really just has accelerated it. So have your views changed since COVID started, or have they just been accelerated?
I don't think actually anything's really changed. I would say, some of the process, and I think we talk about that later, of investing has changed slightly, but the opportunity in front of entrepreneurs is exactly the same as it was before. Certainly accelerated, pulled forward. People are saying 5, 10 years. We don't worry too much about that. I think, even if we made an investment today, hopefully partnering with companies that are building into kind of the wave that's coming in the next 2, 3, 5 years anyways. And so, yeah, it hasn't changed kind of our opinion, but there's obviously increased complexities and challenges with work from home, whether that's, securing your network, collaborating with your team, and, even just structurally building a business.
Yeah, absolutely. Well, you touched on this just briefly, but at CRV, you focus on SaaS, cloud, enterprise IT, and big data. Which of these areas are you most excited / interested in that you have yet to invest in?
That I've yet to invest in. Okay, well, I think broadly the commonality across all these companies is these are businesses that are digitizing processes that weren't previously solved. So Carrot, for instance, is a digital health company that has seen incredible acceleration thanks to the demands in the market over the last few months. GTM Hub is solving the problem of digitizing high-level company goal setting and how that information disseminates throughout an organization, which has only been exacerbated by people not being able to sit in the same room and have management meetings through companies like Squire, which is a vertical SaaS business that is helping barbershops get online, receive contactless payments, and still stay open while it's mandated that there's no walk-ins in many states, given COVID. Through even the simple developer tools being the enablers of all 3 of these applications. Actually, I believe two of the 3 of these other companies are Vercel customers. and users of the product as they help front-end developers get a website or application up on the internet, up and live. The areas that I haven't or that I see a ton more opportunity coming up, the idea of kind of vertical payments and software intersection. You see that a bit with Carrot. As they process a lot of payments for their customers. You see that with Squire, where they're processing a lot of payments. I think we're going to see more and more of that intersection of kind of software plus payments and financial services broadly, and it'll be enabled by a lot of the advances at the infrastructure and developer tooling layer.
Yeah, we're seeing a lot of API marketplaces, especially in the fintech and challenger bank space. That sounds like a very exciting sector. Are you looking at that actively, or have you already made investments there?
Definitely looking at that, but I would argue that the equity value will likely accrue much higher in the stack, and it'll be the end applications that end up consuming those APIs that will benefit the most. Squire is a great example. They now take a cut of every transaction. They are launching lending and banking products, all of that enabled by those APIs that you mentioned.
So the interface layer is where there's going to be a lot of value created, you're thinking. Gotcha.
Absolutely.
So, one thing that I've been dying to ask is, given so many of CRV's investments go public, does the firm think about holding investments post-IPO after already being investors for several years? And also, do you have any comments on the recent push towards direct listings, SPACs, et cetera?
I can't get into too many details about the actual firm's policies and how we handle kind of public investing, but I think broadly our stance is we are private market investors. There is a whole different group of professionals that are public market investors, and they have different technology, different teams, different backgrounds. So we have our expertise, early stage venture, and there are people that have expertise elsewhere. As far as SPACs go, and by the way, we do advise, obviously, our entrepreneurs all the way up through, but you won't see us sitting on public market boards for 15 years after the company's gone public. We believe that our skill set is best helping the companies get to that point. As far as SPACs and direct listings, we've had several conversations. It's kind of fascinating to track down, and we've actually had several bankers give us kind of information sessions because they smell opportunity here. I think the reality is that it takes pretty special companies still that can kind of generate kind of the retail and consumer investor interest. It's a very, very complex vehicle when you actually get under the hood. Simple concept, but complex vehicle. So I don't have an informed opinion of, is this the future and this is how every company is going to go public necessarily, but there's certainly a lot of very smart people and some great companies that are deeply exploring this.
Yeah, it sounds like your background from RBC Capital Markets, similar to mine, definitely lends a hand when looking at things like this, but it doesn't sound like you want to go back there to the public side and really enjoying the private side, just like I am as well. So I appreciate that insight. I've done some research on things that you've really been excited about, and you've stated that you think students will no longer need college degrees in computer science or engineering to obtain high-paying jobs at Google, Apple, Facebook, etc. Instead, they will get nano degrees or other education credentials from a few months of online courses and coding academies. How do you think non-computer science engineering students can also prepare themselves for this style of learning? And are you making investments in these areas today?
Yes, so I think the main point of the first statement is that I'm not convinced that traditional BA, CS degrees are necessarily the best way to learn the trade of being a software developer. And the value for companies like Apple, Facebook, Google is a skill set. There is certainly the intangibles and the communication and all the other great things that you learn through a college program, writing skills, you name it. But I think that really what some of those companies are looking for is the actual skill set within a given language, architecture, system. And I believe that, you can learn more and more of that on your own online without necessarily going through a traditional 4-year college or university. And then on the second part of the question, I think that on the investment side, we continue to be excited about kind of broad online learning and kind of the consumer trends there. We still are large investors in Udacity, so we wouldn't make a competing investment. And then additionally, on the employee benefits side, I think that there's a huge opportunity. Employee benefits and workforce training, we're seeing a lot of opportunity there to up-level existing employees. So for instance, one of my good friends worked at Liberty Mutual in New Hampshire and was a business analyst, kind of a generalist liberal arts degree that he received. And his job was essentially going away, but they offered an internal program, kind of a boot camp for learning how to become a developer, and he went through that, and now he's a level 5 back-end engineer at Liberty Mutual. Great job, and I give a lot of credit to the organization for enabling kind of the up-leveling of their own employee base.
Yeah, definitely agree. I mean, we've seen that with our own investments in companies like Synapse and Enterprise Education. I think the retooling of individuals at sort of, traditional BA degree jobs is going to come in more and more from the institutional side rather than the government public side as mandates. And I think the digital trade workforce is going to only become more and more popular. It's almost like diversifying your portfolio, but with different types of degrees and different types of credentials, and having the freedom to have different revenue streams from an income standpoint is also going to be something that comes out of maybe a post-COVID world as well. So I guess, just tailing on to that, how has COVID impacted your team's ability to invest and manage the fund? And, we saw at the beginning, you were able to raise funds from investors without face-to-face meetings. Have you deployed any of that capital without any face-to-face meetings with founders? Yes,
that's the big question kind of in the Valley is, are people actually transacting and doing full COVID deals? The short answer is, the first couple months, we didn't make any kind of net new investments of entrepreneurs we hadn't met before. A lot of our time was either spending with our current portfolio or investments that we had just, that we've been tracking the entrepreneurs for a while. But over the past 6 to 8 weeks, we've made several investments, never meeting the entrepreneurs in person and building a relationship completely, over Zoom essentially. I think that actually there's certainly been some positives and negatives to it. The positive is that calendars are essentially open for when people are fundraising, and it's my job on the other end to be available as well. So I've actually gotten to spend arguably more time with the couple entrepreneurs that I have decided to invest in than I would have if I was flying across the country or trying to do phone calls and managing schedules on both sides. So that's been a nice positive where I feel like I've actually advanced the relationship that much further just with more time. But in the end of the day, this is, nothing kind of beats in person, getting to know someone. So that's certainly missed, but not, hasn't been a barrier for us. On the internal side at the firm, with a very small team, it works very closely together. We're constantly kind of pulling each other in and out of meetings to help look at projects, help vet opportunities, help out our entrepreneurs. That's been missed big time, but we are very active, giving each other calls and kind of constantly keeping each other up to date on what's happening. But that's another more on kind of the personal and cultural side, a big miss for us.
Yeah, for sure. I think like a lot of those impromptu conversations you have by the water cooler are being missed, and your calendar is definitely more open, but it's also probably more full with like defined time periods to have meetings and stuff with individuals inside the firm or outside the firm. So absolutely. It sounds like you had, a couple of months of maybe the bit of the triaging at the beginning of COVID, and then things sort of returned back to normal. And now you're actually investing again, which is great out of this new fund. So very excited to hear that. And hopefully we can find something to work on together. So moving to my favorite part of the talk, which is your book recommendations. You have 3 great books here. So can you tell us about each one of these and why the audience should check them out?
Yeah, very simply, the 4. I think there's no better way to look at the tech world and kind of the history of business than looking at these 4 companies and kind of uniquely how they got where they are today. It kind of tracks the history and some of the ways the entrepreneurs kind of navigated the market. Some of the luck involved and some of the very strong strategic moves. So just a huge fan of that book. Led mainly, Scott Galway does always is such a kind of engaging author and maybe not the most exciting topics, but this is a great quick read. And I'm personally, Amazon is just a company that I can never read enough about. So it's fun to see how he weaves that narrative in with Apple, Facebook, and Google. Startup Land hits close to home. CRV, we were very fortunate to be the Series A investors in Zendesk. And hearing that story kind of firsthand from Mikkel, he has such a kind of calm tone, methodical, but very strong perspective throughout the whole book of kind of how tough it is. There's a business externally that has an incredible Zen brand. If you looked at the numbers, it's always been up and to the right, but really, really challenging plight of an entrepreneur as you build a company, managing relationships, managing your co-founders, moving your family from Europe to Boston, hating it, and then finally ending up in the Valley, actually in San Francisco, showing up at the office and in the middle of one of the toughest parts of San Francisco, the Tenderloin, and just kind of being physically ill with how sad the world around him is, and all that he did with Zendesk to kind of bring in the community and kind of engage the community with his employees, and just a fantastic, honest, heartfelt, but engaging read. And then Good to Great I added on here. I actually am embarrassed to say I haven't read it yet, but it's sitting on my nightstand and I am just continuing to look at it and then fall asleep. But this comes very, very highly recommended to me by several people.
That's awesome. Those are 3 great books. And it's really cool that you were able to play a small part, or your firm was able to play a small part in the Zendesk story. And I've heard that it just gives you a real inside look at all the things that an entrepreneur has to go through from beginning to end, and the challenges they face, the good and the bad. So I think that those are great recommendations. Before we wrap things up, we always ask our guests for any final words of inspiration for our audience.
I just think there's almost no better time to be an entrepreneur. We have plentiful capital available to help companies get off the ground. We have incredible trends of the world needing to be digitized overnight. A bunch of people that are looking to get behind an entrepreneur and work with you. So that'd be kind of my one piece. It feels like just an awesome time to be an entrepreneur.
Yeah, I couldn't agree more, and really appreciate your sharing your story and your words of wisdom for us. Thanks so much for doing this, Reid.
Thanks, Matt. Appreciate it.